On June 29, 2000, the New York Stock Exchange witnessed a single company's market value surge past $250 billion, a figure that placed Nortel Networks alongside the world's most powerful conglomerates. Once worth $250 billion, then destroyed by one accounting scandal, Nortel's meteoric rise and spectacular fall reads like a cautionary epic for an industry built on invisible signals and relentless ambition. In the aftermath of World War II, a modest Canadian research lab in Montreal began tinkering with microwave technology for the armed forces. By the 1970s, the fledgling firm, then known as Northern Electric, had pivoted from military contracts to the burgeoning world of telecommunications, supplying switching equipment to the newly liberalized telephone markets across North America. The company's early success rested on a single principle: make the network faster, cheaper, and more reliable, and the world would pay for it. The 1980s brought a seismic shift. Deregulation opened the doors for competition, and Nortel seized the moment, investing heavily in digital switching and fiber optic infrastructure. In 1989, the firm rebranded as Nortel Networks, shedding its old-school image and positioning itself as the vanguard of the digital age. The company's research labs churned out innovations that would become industry standards: carrier-grade Ethernet, voice-over IP prototypes, and the first commercially viable broadband solutions. By the early 1990s, Nortel was not just a supplier. It was a partner to the world's biggest telcos, and its stock began an ascent that would define a generation of tech optimism. The dot-com boom of the late 1990s amplified that momentum. Investors, dazzled by the promise of a new economy, poured capital into any firm that touched the internet. Nortel's quarterly reports glittered with double-digit revenue growth, and its market capitalization rocketed from $20 billion in 1995 to over $250 billion by mid-2000. The company's headquarters in Ottawa swelled with engineers, salespeople, and a cadre of charismatic executives who cultivated an aura of unstoppable progress. In boardrooms, slogans like "We're building the future of communication" were spoken with the confidence of prophets. Yet, beneath the gleaming facade, warning signs began to surface. Analysts noticed that while revenues grew, profit margins were thinning. The company's aggressive acquisition strategy, most notably the $3.1 billion purchase of Bay Networks in 1998, added layers of debt and integration risk. Internally, a culture of target-oriented performance metrics encouraged sales teams to close deals at any cost, sometimes sacrificing quality for volume. Engineers whispered about product delays and compatibility issues, but the public narrative remained one of relentless expansion. In early 2001, the first cracks became visible. Nortel announced a $1.5 billion write-down of its network equipment division, citing unrealized market potential. Share prices slipped, but the broader market, still caught in the euphoria of the tech bubble, brushed it off as a temporary hiccup. A second, more ominous indicator emerged when senior finance officers began to shuffle accounting practices to smooth earnings. Revenue recognition was accelerated, and expense deferrals were extended, creating an illusion of consistent growth. These tactics, while not illegal at the time, set the stage for a catastrophic misrepresentation. The turning point arrived on December 5, 2004. After months of internal audits and mounting pressure from regulators, Nortel's CFO, Frank Dunn, publicly acknowledged that the company had inadvertently overstated earnings by nearly $300 million over the previous 3 years. The confession sent shockwaves through the market. Investors, already jittery from the post-dot-com slump, fled in droves. The stock, once a symbol of tech might, plunged more than 70% in a single week. Credit agencies downgraded Nortel's debt, and banks tightened the credit lines that had financed its aggressive expansion. Legal battles followed with a ferocity that matched the earlier financial turbulence. The Ontario Securities Commission, the U.S. Securities and Exchange Commission, and multiple class action lawsuits converged on the company's leadership. In 2006, former executives, including Dunn and former CEO John Roth, faced criminal charges of fraud and falsifying financial statements. The courtroom drama revealed a labyrinth of internal emails, altered spreadsheets, and a board that had turned a blind eye to red flag warnings in order to protect its market image. By 2009, the once indomitable giant was a shadow of its former self, unable to secure new financing, and with customers migrating to rivals who offered more transparent pricing and newer technology. Nortel filed for bankruptcy protection in January. The filing marked the end of a 129-year legacy that began in a modest workshop and climaxed in a global empire. The liquidation process stretched over several years, with assets sold off to a parade of competitors. Ericsson acquired its CDMA and LTE patents. Avaya purchased its enterprise solutions, and a consortium of Canadian investors snapped up the remaining intellectual property for a fraction of its former market value. The aftermath rippled far beyond the balance sheets. Hundreds of thousands of employees, many of them highly skilled engineers, found themselves displaced, leading to a brain drain that weakened Canada's tech sector for years to come. Pension funds, some of which had heavily invested in Nortel stock, faced massive shortfalls, prompting legislative reforms on corporate governance and retirement savings protections. The scandal also ignited a wave of regulatory reforms aimed at tightening financial reporting standards, especially in the telecommunications industry, where long-term contracts and massive capital expenditures can obscure true performance. Perhaps the most enduring legacy of Nortel's collapse is the lesson it imparts on corporate culture. The relentless pursuit of growth, when untethered from ethical accounting and transparent governance, can transform a visionary enterprise into a house of cards. Subscribe to The Collapse for more stories like this.